I used to be a perfectionist. I hated mistakes. I just beat myself up when I made one. Then I got into the tax business. There's mistakes every year. Everybody makes them. Sometimes it's your clients, sometimes it's you, sometimes it's something you have no control over. But they get made. And I've learned quickly that mistakes are really a good thing. So about a month ago, one of my clients called me. He said, "John, I got a letter from the IRS. I hear that 2 or 3 times every year." And I said, "Well, send it on over. We'll see what we can do about it." So he scanned it and put it in an email and emailed it to me. And when I got it, I couldn't read it on the screen, so I printed it. I reached over, picked up the stack of papers from the printer, flipped them up so I could see the letter. Immediately, my eyes focused on one number, $170,000. That was the balance due. And then I noticed another number. It was about $40,000 for interest and penalties. That's what I would pay if I made a mistake. So I was a little bit concerned. And I see this frequently. And when I first see the letter, I get all upset and I'm thinking, oh, what did I do? And then when I think about it a moment, I say, wait a minute. This is totally wrong. This cannot be right. It's too much money for the work I did. So what it was an IRS letter with a big amount on it, and they like to send big amounts because they get your attention. Some people take these letters and just throw them in the trash. And then once the due date is passed, the IRS sends more letters and things get worse. So I knew it was wrong. So the reason I knew it was wrong is this is all about an employee stock ownership plan. In a plan like that, your employer gives you options to buy stock. The option has a price. And the options they give you have a total value which goes on your W-2 form to be taxed. So you go buy your stock, you get a deal on it because you have the options, and when you buy that stock, you acquire a cost in that stock, which is important. So those two numbers are very important. The income they put on your W-2 form and the cost, what you paid for the stock. And it's really funny. You can't determine what the option amount was without looking at the last pay stub for the year. The IRS will not allow us to prepare a tax return using the last pay stub of the year because there's frequently an adjustment to the earned income between the last pay stub and when they produce the W-2. So we have to use the W-2. But in this instance, we're being forced to use the pay stub, which makes me nervous anyway. And we're also being forced to use documents that we're totally unfamiliar with, like the documents that show what the taxpayer paid for the stock. And that can be challenging. We don't like to get outside of our little forms. But sometimes you just have to. You're just forced to. And that's why this business is so fun and interesting. You run into all kinds of situations, and you never know if you can overcome them or not. But I'll tell you something. I haven't failed to overcome one of those yet, and I'm probably not going to. So the employee stock ownership plan is different from a normal purchase of stock. When you buy an asset, you sell it, you calculate the gain or loss on the sale the same way, whether it's a house, an investment in stock, or some other kind of investment. You take the sales price, you subtract the cost, and what's left over is a gain or a loss. And in most instances, if it's a loss, it's deductible. But if it's a gain, you have to pay taxes on it. And so he had about $350,000 of sales out of this employee stock ownership plan. So I put that on his tax return. It was there. First thing I did was check to make sure it was there. It was there. But I showed no gain or loss because I knew there was not going to be a gain or a loss. I'd already figured it out. So we went back and looked at the return, trying to figure out what was going on. I sat down. I'm not really familiar with ESOPs. This is the first time I've actually done one on a tax return. So I had a little learning experience ahead of me. So went back, figured it out, looked it over, studied all day long. About a couple of weeks ago, I missed one of our meetings. I was at my office at 8 a.m. working on this problem. I mean, normally I would just put it off, but you can't put off $170,000. So, and I'd taken a class on this a couple of weeks before. So I had my class materials, I had a letter from his employer, and we studied that all day long and finally figured out how to do it. We needed to take that $325,000, subtract out his cost, which was about 200 something. And then there's one other thing we could subtract. That's the income that was put on his W-2 form. And this just blows me away because we just took income and turned it into a cost. But the reason we have to do that is that income has already been taxed. So you have to subtract it from the sale so it won't be taxed again. So things worked out really well. And I had a wonderful learning experience. That's what I like about this. You make a mistake, you fix it, and you learn something. Now I know how to handle an employee stock ownership plan. I know what to do. I know where the numbers go. I know what I need to do. We filed a amended return last Friday, and it was accepted, and I responded to the IRS letter via fax. I think we're going to be good to go. So it was a great learning experience. It was a great customer relations experience. My customers know when they have a problem, I'm going to be there for them. I don't shut the door and walk away after April 15th. I'm there pretty much every day during the week. And that results in stability for my business. People come back. People like me. And they trust me. And they stay with me. And that's the whole objective of being in business for yourself. Madam Toastmaster.